Welcome back to Investment 360. Yolande Naude, Head of Fund Research at Citadel Wealth Management, joined us for a look at global equities, particularly how those in emerging markets are currently the most attractive investment opportunity for South African investors.
We understand our view is contrarian, but it's very strongly based on specific opinions on fundamentals in the economies, on what we see with the health of corporates in emerging market countries, and also in terms of valuations.
Yeah, valuations of course being the key, and there are certain countries I know that you think are cheaper than others and certain that are more expensive. Before we go back to Johannesburg, just give us an idea of the cheap ones and the expensive ones.
Russia is by far the least expensive at this stage. It's selling at a PE of 5 and a dividend yield of 3.5. In addition to that, Brazil isn't expensively priced, and China also looks like value. And on the expensive side, South Africa is very expensively priced relative to other emerging markets, and Mexico is also not a cheap story anymore, and that's a fascinating one because their economy is actually doing fairly well, but it looks as if their stock market has already discounted all of that.
Bronwyn, we're expensive, South Africa, in the emerging market world apparently.
What about the other African countries, Yolande?
Other African countries have similar kind of exposures. And the valuations aren't cheap at this stage. It's also a lot more risky if you go into the frontier markets because of governance and political issues. So investors who distinguish between frontier markets and emerging markets should be careful when they invest in frontier markets. In our opinion, there's a lot of value in emerging markets at the moment. You don't have to go to the frontiers where there's lots more risk.
When you come to the determination of what country is cheaper or cheap and not, do you adjust upside to fair value? Do you adjust that for structural value creation like ROEs, for instance? And if you do so, and even if you don't, I guess, the question is, what kind of sectors within these countries do you tend to find value in? If not sectors, what kind of fundamental specifics are you seeing in these countries where there are pockets of value, or where pockets of value lie?
In terms of valuation, we look at various valuation measures. We look at price to earnings ratios, trailing earnings and forward earnings, look at price to cash flow, dividend yields, and also price to book levels. So if you look at a combination of all of those factors combined, and you equally weight them compared to 10 years of history, for example, then specific sectors in emerging markets that appear inexpensive at the moment are, for example, your financials. They have sold off aggressively, so especially in Europe, and they look like good value at the moment. And we also see value in the energy stocks. On the expensive side, it's very similar to South Africa, where we see the consumer-related stocks as expensively priced, especially also healthcare. And that's similar to what we see in South Africa at this stage in terms of company valuations.
Yolande, Wayne, yeah, I must say I agree with you about your summary on the South African share market as to the whole market being expensive and in one sector or a few sectors being cheap relative to that. But my actual question is there great value in other emerging markets, as you've already spoken about, in a rising interest rate environment? I mean, we've seen long bonds globally go up quite significantly, and it's just a question of time until short-term rates start to go up worldwide again. I mean, we're already seeing in developing markets quite significant increases in short-term interest rates. Is this the right environment to buy developing market shares in despite their current valuations? I'm talking about the cheap markets now.
That's a significantly good question, and that is a major risk at this stage. The question is how much of those risks have been priced in already. And if you look specifically at financial stocks, we are most at risk in a rising interest rate environment. In the emerging market space, they seem to have discounted a lot of those risks already. They are cheaply priced at this stage, and they seem to have already discounted that. In terms of other countries, there are risks if interest rates normalize, but if you look at the emerging market performance, year to date, for example, they underperformed developed markets by 5%. Over the past year by 25%, and cumulatively over 3 years by 35%. So from a pure valuation perspective, a lot of bad news have already been priced in by emerging markets, and from our perspective, it's definitely a time to go into them. In general, but investors have to distinguish between where they go into and what they go into, especially also from a valuation perspective. Because you may think a specific market is expensive, like South Africa, for example. It's not cheaply priced, but there are specific sectors, like the resources sector in South Africa, that's inexpensively priced still, and that does offer value. So if investors go into this emerging market asset class, we would definitely say to them that they have to go in with a level head, expect volatility, take a long-term perspective, and then also take an active approach. And with active, we don't mean going in and out. It literally means buying or giving your money to experts that can invest it for you in the right stocks.
Yolande, let's just wrap this up now. Is there any chance that this is another 1998? In other words, a really horrible emerging market rout? Because if there's so much debt out there that has been borrowed by emerging market economies, and if interest rates do go up, then there could be something similar to the 98 scenario, very briefly.
We definitely don't see that. If you look at a number of economic variables, if you look at external debt as a percentage of the size of the economy, or net debt as a percentage of the size of exports, for example, those have come down tremendously. From about 160% 1995 to around 60% at this stage. Fiscal deficits have much improved. Current account deficits have also been much improved. So we don't see the same kind of economic risks that we have seen in 1997-98, especially that caused the crisis that started in Thailand. We don't see that, and therefore we view the asset class as being attractively priced.
An uncertain regulatory environment and continued strikes in the platinum belt has painted a gloomy